Hi, and welcome to a Trader Today for the 8th of September. My name's Tom. I'm a senior trading analyst here at Trendsignal, and I want to walk you through an intraday opportunity that I just went into and closed, talk a little bit about the trade. And to be honest, this is a bit of a weird one for these videos because it's actually technically still live. There will still be members working with Trendsignal that are just seeing this trade out a little bit further. Let's not waste any time, really. Let's jump in. We're looking at the German 40 markets. It's our intraday strategy. And for a little bit of context, the Trendsignal, we've been teaching people to trade the market safely since 2003. Essentially, we're going to show you those concepts. And we have a webinar later today that I'd like to invite you to where you can trade alongside on this strategy with us as well. So this is the opportunity. It started at 9:04. As I say, German 40, 2-minute candles on our intraday strategy. There's a 5-step process for identifying entries as part of this market. Once we've identified those entries, it's just running it according to the strategy or according to a discretionary exit. So let's go through it. Let's just not waste any time, jump into the trade, and then we'll talk about how you can manage it, how I actually managed it in practice, what I achieved, and the total potential return off of this as well. So number one, we have an arrow flip, black arrow. From the bottom pointing up, it acts as a stop loss for the previous trade. The candle is hit, which means we now look for a new potential opportunity. The initial black arrow starts outside of the blue band, so that's the first rule. It tells us the type of trade we're looking to take. We're taking something called an explosive trade, which is when the market is stretched quite heavily. The best analogy would be like if you really string back an elastic band, it's going to ping really fast. That's this type of trade, essentially. But just because that's the type of trade doesn't mean that it's actually a good time to take that type of trade. We need to look at other factors in the market. The second thing we look for, these two lines down here that change from green to red, they're called vector averages. We just need them to line up in the direction we want to take. Our arrows are pointing down, indicating a short. Both of these are red, indicating that the lower time frame is supporting that as well. So we're all good. We then need to look for step 3, which is the candlestick position. When our arrow is outside, our candlestick needs to be below the black line in the center, we call PE1, in which case it is, so that's perfectly good. We then move on to step 4, which is the R ratio. You can see this in the left-hand side of my screen highlighted. If we hover over the candle, you can see it's 30.65. It just needs to be above 0 or colored green, either or, same thing. Which it is. So again, we're perfectly good to go. And for this type of trade in particular, we don't actually need to use Rule 5, but I always think it's helpful just because if it is lined up, it tells us that this is probably going to be a stronger move and gives us a good expectation of what to take out of the trade, essentially. In this case, we have the blue to orange change color line, the intermediate trend. We can see that it's orange. So every single factor is telling us that this is likely to be a high probability entry if we choose to take it. So what happens? We open the candle, we jump into the opportunity. You can see the entry point at the top here, okay? Open 23767.72. Trade develops. Now there's a couple of ways that you can choose to run this. Now the distance from the open to the absolute bottom of what it's achieved so far is about 44 points. I'm not going to pretend that anyone's going to get exactly dead on 44 points with anything short of luck. In my particular case, I took 30. The reason I took 30 wasn't so much due to the structure of the market. It was the first trade I've taken in the morning. And I really like to take a decent winner, not too aggressive. I'm not expecting it to run 100 pips every time, but take a smaller winner, give myself a little bit of mental space so that I can run the later trades with a bit more confidence. And I say this as somebody who's been trading for nearly the best part of a decade. Sometimes just not being your own worst enemy is the best thing to do when you're doing an actual trading session. But for those people who weren't going for some sort of target or just took out the market based on their own discretionary analysis, there is an absolute rules-based exit that you can use as part of Dynamic Trader. It's these black arrows that you see on the screen. Now, we almost came out for a stop. Those that haven't exited the trade and were still holding it all the way back up have now resumed their leg back down, and now they're probably about 10 or 20 pips into profit. But there's also an extra opportunity for someone like myself. And I've missed this one because I'm recording the session, I will say. But what happens? We drop, we take our profit, we come out of the trade. It turns back up. Our lower time frames turn from red to green and then back from green to red. Now, the confirmation of this double reds happened at the bottom of this candle here where my cursor is now, which means that if I was taking what's called a continuation trade, as the name implies, I can continue the motion that we saw previously. This is how we increase the amount of trading opportunities we have compared to waiting 30 minutes for every single arrow flip, because that can get a little bit boring. As long as the structure supports it, then it's all good to go. We can trade in and out of markets, protecting our capital, not letting our winners run back against us, but ultimately taking profits as we go, and being sensible. For a little bit of context, I mean, 44 pips. I mean, if it's a pound a pip, nice and easy math, it's 44 quid. But by the time you're trading at something like £5 a pip, it's £220. And I want to go through how quickly you could have achieved that, because it does sound a bit silly. You have the initial candle, 2 minutes, 4 minutes, 6 minutes, 8 minutes. Somewhere within the 6 to 8 minute mark, you would have made the best part of 220 quid trading at £5 per pip. Now, there will be people trading that same trade who are still in this trade. They've made a little bit less, but what we can see on the charts, okay, high, low, lower high, higher low. So it's not necessarily a market that's particularly primed to push further down. To me, it reads as if it's going to push a little bit sideways, but you can see how good my intuition is, because you'll be seeing this in the future. But yeah, if you want to trade this strategy, you want to achieve results like that, you want to see how we make these calls and how we do everything, the good stuff, the boring stuff, the useful stuff, then we do a couple of sessions live trading this for about an hour and a half. We have one today at 12:30. If you're interested in joining us, there should be a form around this video. Hopefully we'll see you then. Bye bye for now.